Welcome to a new episode of FinTalk by BHM Capital. Today we are gonna discuss something very important. It's a bit advanced, but people have to know about it. It's market making and the role of investment management in market making. For this subject, we have the expert with more than 30 years of experience in the capital markets, Mr. Galen Moore.
Hi, Man. Thanks for having me on.
How are you today?
Very well.
We want to start by clarifying some, definitions to people. What is market making?
Sure. So the role of the market maker is very important in the capital markets and specifically in the equity markets. Our role is to put risk prices into the market for our own account. And we do this to make sure that investors have the opportunity to always be able to buy and always be able to sell securities. And one of the major benefits of this is narrower spreads and deep liquidity in the market. And this continuous process encourages more people to come to the market, which means that there's more liquidity, which means that more people come to the market.
So one of the issues people might face if they buy a share is the inability to sell it.
Yeah.
Because nobody wants to sell it.
Sure.
And if they want to buy something that no one wants to sell, then they're losing the opportunity. So by market making, you are putting the bids and offers all the time to let people be able to buy and sell.
That's right, yeah.
At the prices that you wish, not them.
We set the price sometimes. We sometimes follow the price. So our role is to try and make the spread as narrow as possible. And the more competitive this is, the narrower the spread becomes. And we skew our buy and sell depending on market conditions.
Once you reach the office, until before the trading session, what do you do?
Well, our business is very much based on repetitive averaging of process. And we, on a daily basis, put something like 2,500 to 3,000 risk prices into the market. We have to react to that risk on a second-by-second basis. So unlike most investors who have various time frames of weeks, months, years, our time frames measured in literally seconds or minutes. And so we have to be very quick, very nimble in how we manage our risk, how we look at the risk. And so our process starts first thing in the morning, probably 2.5 hours before the actual market open. And we analyze the global macro events, global or micro events that are happening in our market, in the global market. And we then form a basis for how we want to trade today's trading session. And once we have a very broad idea of how we want to trade, whether we want to be better to buy, better to sell over the trading session, we then look at each individual stock and do an analysis of that stock. So if I can take an example of EMAR, which is very relevant over the past few trading sessions, and we make a market in 68 different stocks. So this has to be a process which we follow diligently. But if we go to EMAR and look at EMAR as the example. So EMAR, obviously, largest builder in Dubai, very widely held by foreigners. And this is information we can get from the exchange, get from our contacts, our knowledge in the market. We know that about 45% is owned by foreign investors. And so their motivation for trading in the stock is different from somebody who, say, lives in Dubai. And so we look at the motivations of everyone, but what's happened recently, and this is a very good example, is that there's been extremely heavy buying of EMAR, and it's moved from 7 dirhams to 8 dirhams, which is, for a stock which is the fourth biggest on the DFM, it's a big move. So why has the stock moved this much? What's happened? And so news has come out that they're getting into the domestic real estate market in Saudi. So there's obviously been huge amounts of buying on extra large volume over the past few trading sessions. The news has come out, the stock's moved, and our job now is to figure out, what do we do from here? How do we go about trading?
My question here is, how could you manage 68? What you do is basically a planning session for the strategy of investing.
Yeah.
So how could you, or how can you plan the strategy for 68 stocks?
So we have a very large database that we use. We look at various signals like moving averages, whether the stock's in a trend, for example, whether it's above its 20-day, 50-day, 200-day moving average. Now, if it's in a positive trend, we obviously don't want to be short of that stock, because then if that trend continues, we'll lose money. So getting back to Emaar, we can see that this is in a positive trend. There's heavy aggressive buying, but we have an obligation to the exchange to buy and sell. So we're obviously going to have to sell at some point, even though we don't want to. So what we do is that we analyze the trend, we look at the various indicators, moving averages being one, relative strength being another. Has foreign ownership increased? Are there going to be redemptions or creations from ETFs? And then within our market-making trading platform, we skew our buy and sell to reflect that view. So going back to Emaar today, we thought that the buying would continue as these trends tend to keep going. And so for our obligation to the exchange, we were a buyer of 20,000 shares for every 10,000 we were willing to sell. So this gives us a position that for every time, if we trade twice if we sell twice, we sell 20,000, we only have to trade once at the bid price to maintain our position.
Makes sense.
And what we try and do is make the difference between the price people sell at and the price people are willing to buy from us at.
Execution. From the beginning of the session until the end of the session, 68 stocks,
Yep.
a huge number of orders, buy and sell at the same time. How do you do that?
So our desk is split. We have four members of the desk. Each member of the desk has their certain securities they look at and trade. And my job is to manage the overall risk of the trading during the session. So we have individual risk limits on stocks. We have individual book limits, which we can't exceed. Now, if you drill down into each stock, and your book is either going to be naturally long, naturally short as the trading session goes on, we make adjustments to our algorithms during the trading session to ensure that our skew, going back to the 20,000 we were buying, 10,000 we were selling.
So from what you're saying, is this automated trading?
Yes. Yeah.
So algo trading is what's happening.
Yeah. So each stock has its own specific algo parameters. And within those, we change those parameters and check those parameters on a daily basis to reflect our view of the market.
It looks like a pilot's job. Before takeoff, you do all the programming, you tell your plane where to go, and then you sit and watch, and then whatever happens in the flight, then you keep changing your systems to, it's like an autopilot, is it?
It's slightly different because with the pilot, you know where you're going. You know your destination. We don't know what that destination is going to be. We could take off thinking we're going to New York and end up in Tokyo. So we have to make very, very rapid adjustments to our flight plan every minute to make sure that we get to the destination we want to get to.
At the beginning of your talk, you said market making is important to markets and to investors. We want to focus on the investors. How can we help, or how can market making help investors? And does the availability of market making in each market, in any market, does it make it more healthy?
Absolutely. Because if you didn't have market makers, what would happen would be, say you're an investor and you want to trade, and nobody was a buyer. How could you sell your stock? You couldn't. And this is where the market maker comes in, because there's always going to be a price I'm happy to buy the stock at and a price I'm happy to sell the stock at. And what generally happens is that the more liquid the stock, the less need there is for a market maker all the time. Whereas some of the more illiquid stocks that we make a market in, we have to be there. Otherwise, there would be a 5, 6, 7% spread, which means that it's unattractive for the company to list on the exchange, and it makes it unattractive for an investor to actually trade that stock.
How much is the effect of regulations? How regulated, how powerful are the regulations in your role? Because it's totally different than brokerage. It's totally different than investment management. It has its own set of, regulations that takes you somewhere.
So we're very cognizant that what we do, because we're trading for the firm's money, we're ring-fenced from all the other areas of BHM Capital. We're a siloed business with our own lines into the exchange, our own order management system, and we could be on the moon as far as any fully segregated from any other interaction within BHM Capital. So we're very highly regulated by ESCA and the exchanges with what we do.
The last thing is your advice. What would you advise new investors who are entering the market from your not only market making but investing experience over the years, starting from London Stock Exchange all the way to the UAE today?
Yeah.
So what is your advice to investors?
I think to understand the company you're investing in. And if you don't understand what the company does and how it makes its money, then don't invest in it. Some companies are pretty easy to understand, like Salik. Some are completely beyond my grasp, like NVIDIA.
Yeah.
So, understand the company you're invested in and understand how they make money as well. Because after all, when you buy a stock, what you're doing is buying the future cash flows of that company. And if you understand how they make their money, then you can make a good idea, make a good decision based on their future earnings.
Thank you, Galen.
Thank you, Mom.
I'm sure what you said today was more than enough for beginners, and it's really useful for people who are also advanced.
No problem.
Thank you for watching today's episode of FinTalk by BHM Capital. Stay tuned for more episodes.